You've stayed in enough of them, done the math on occupancy rates, and decided hotels are a business worth getting into. Every year, the global hospitality industry pulls in over $1.5 trillion in revenue. But the hotel you think you're buying belongs to you in name only. Major brands like Marriott and Hilton own almost none of the properties they manage. Hilton, for example, owns just 3% of its 9,000 locations worldwide. The other 97% are owned by private investors and real estate funds. These are the people who pay for the land, the concrete, and the construction crews required to build a multi-million-dollar structure. Once the building is finished, the brand sends the owner a PIP, a property improvement plan. This is a mandatory list of renovations, from new furniture to lobby redesigns, that must be completed to keep the brand's name on the sign. If an owner refuses to spend several $1,000,000 on these updates, the brand removes its flag. Without that reservation system and those loyalty points, the investment becomes an empty building with beds. Even when the lobby is full and the rooms are booked, the building's owner is the last person to collect a dollar. On $5 million in annual revenue, the brand first takes a 6% royalty and marketing fee. Professional management adds a 5%. They shifted their business away from owning property to collecting fees. In 2025, Marriott reported $5.4 billion in fee revenue, money they collect from owners for the right to use their reservation systems. This model allows the brand to collect its percentage of every dollar earned, regardless of whether the owner is actually turning a profit. If the economy slows down or a roof needs replacing, those costs fall entirely on the person who owns the building. By letting private investors carry the debt and the maintenance, the brands have built business where their primary expense is maintaining software and intellectual property. Given these thin margins and the leverage the brands hold, it seems counterintuitive that anyone would still want to build a hotel. The American hotel industry is currently dominated by a single immigrant community, Gujarati Indians. People of Indian origin own roughly 60% of all mid-scale hotels in the United States, and they do it by operating outside the traditional corporate structure. Their first generation often buys a small motel and lives on site. By using family labor instead of outside staff, they eliminate the need for extensive third-party management companies. They use vertical integration, treating the major brand name not as a partner, but as a distribution tool to fill beds, while they keep costs to an absolute minimum behind the scenes. They reinvest the proceeds from one property to buy a second, then a third. This creates a network of hotels that shares resources and lowers the per-room cost of operations. This scale provides a buffer against the high fees. By the time they own a dozen properties, the thin margins of a single building are replaced by the significant cash flow of an entire portfolio. For an investor with just one building, the pressure is constant. Every 7 to 10 years, a new mandatory PIP renovation cycle arrives, requiring millions of dollars in upgrades that can wipe out a decade of profit. While the owners struggle with those costs, the brands are projecting record growth. Their pipeline of new franchise agreements has never been larger, and they carry none of the physical real estate debt associated with that expansion. Managing a single hotel often results in a high-stress, low-margin job. Managing 10 properties transforms that labor into a diversified business. The modern hospitality economy has placed the highest value on intangible systems. The reservation apps, the loyalty points, and the brand standards are the components that dictate the flow of money, long before it ever reaches the person who owns the bricks and mortar.